Will the next non-farm payrolls report bring more pain to the US dollar? It's the first trading week of September and everyone's favorite non-farm payrolls report is on the agenda along with the ISM manufacturing and non-manufacturing PMI data. In Canada, the central bank is expected to cut interest rates once again, and that could be a test for an impressive rally in the Canadian dollar, while Australian GDP figures might be a reason to keep a close eye on the Australian pairs. So at this video, I'll briefly explain my analysis on dollar yen, dollar loonie, and Aussie dollar, starting first with dollar yen and the US non-farm payrolls report. Well, the data are expected to show some recovery. The employment growth is expected to rebound, and the unemployment rate is expected to pull lower. So that could be positive for the US dollar. But if the data miss expectations, once again, resurfacing recession fears, so we may see a negative reversal in dollar yen. At the moment, investors are optimistic that a 25 basis point rate cut will happen this month, but there's also a small group of investors who price in a bold 50 basis point rate cut. So if the data miss expectations, the probability for a bold 50 basis point rate cut might increase, and there are overall there are around 100 basis points of monetary easing priced in until the end of this year. So investors are waiting for the Fed to cut interest rates aggressively at some point later this year. So if that happens, if the data urge the need for a more aggressive rate cut, dollar yen might reverse to the downside to test this constraining line over here near 144.80 before heading towards the 143.40 region, a break of which could take the price straight down to the 141.67 low from August. If that floor breaks, then the pair could aggressively fall towards the 137.8 region, where this descending trend line from November 2023 is located. Now, if the data surprise to the upside, dollar yen might extend its recovery phase, and this is something that the technical indicators are also backing at the moment. The RSI is sloping upwards, the stochastic oscillator is also moving higher. However, we can see that the RSI is not above its 15 neutral mark yet, and the stochastic oscillator is very close to its 80 overbought level. So that suggests that additional increases might be short-lived. Perhaps the 148.75, 149.40 region might block any upside increases. There are, the 38.2% Fibonacci retracement of this down leg and this constraining line are also located here. So that could be a tough region for the pair ahead of the 200-day moving average and the 50% Fibonacci level seen between 151.14 and 151.80. Now looking at dollar loonie, the central bank, the Bank of Canada, is expected to cut interest rates for the third time this week. That will not be a big surprise to investors. Investors believe that the central bank will extend its easing process every single month until the end of this year. So the decision itself may not cause strong volatility, but if the central bank urges the need for a bold rate cut, then perhaps we may see some weakness in the Canadian dollar. Dollar loonie has been trending to the downside throughout August. So only a break above 1.3525 could bring some optimism back into play. This is where this ascending trend line, long-term ascending trend line from 2021 is located. So I would like to see a clear close above that before targeting the 1.3585 region. Above that, the 200-day moving average as well as the 50-day moving average could be the next resistance levels at 1.3620 and 1.3650 respectively. Nevertheless, I believe that a tougher battle could take place around the 1.37 number. There are a couple of trend lines located here, so close above the 1.37 region might be a tough task for the pair. Well, from a technical perspective, it seems that the market is already oversold according to the RSI and the stochastic oscillator, so an upside move is likely in the coming sessions. However, if the price rotates lower, breaking below the 8-month low 1.3437, the next support could come around the 1.3360 former barrier, while slightly lower than that, the 1.33 region might be a key area to watch, as this is where this ascending supportive trend line from mid-July of 2023 is located. And finally, looking at Aussie dollar, well, Australian GDP data are expected to come in mixed. There might be some improvement in quarterly terms and steady annual change. So overall, forecasts are may not be much different than the previous readings. Nevertheless, if the data surprise to the downside, suggesting that the RBA should start cutting interest rates before 2025, we may see a downside reversal in Aussie dollar, and that's likely according to the RSI and the stochastic oscillators, which have already peaked in the overbought zone. So in this case, if the price reverses to the downside, support could initially come around the 0.6730 level, where this resistance line from April 2022 is located. Below that, the 0.67 number might be another key area to watch. We saw the price rebounding significantly around this territory a couple of days ago, and the 20-day moving average is also approaching that region, so we may see some consolidation here before sellers drive towards the 0.6650 region. Now the upside, if we successfully overcome the 0.6795 bar, which blocked the way up for the second time, then the rally could pick up steam up to the 0.6880 level, while slightly higher than that, the 0.6910 mark could be critical to watch, as this is where the ascending trend line connecting the highs from 2021 and 2022 is placed. So that's everything I wanted to share with you guys. Thank you for watching, and see you next week. Bye bye for now.